The market can't seem to make up its mind, and I don't necessarily blame it, with mixed signals from a dovish Fed on Tuesday, a hawkish Fed on today's session, and of course, buckle up, we've got the PCE inflation numbers coming out tomorrow morning at 8:30. Maybe that's the catalyst we need to finally kick us into gear. To be prepared for either direction, we will build game plans today for a gap up or a gap down tomorrow morning that are of course based on logic. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on a fairly obscure looking SPY daily time frame chart due to the gap and go nature and the Swiss cheese underneath us, I think it's fair to say that we're still very much so in an overall uptrend here, and we just produced a brand new higher high at the top of today's session. So because we're coming from a higher high, we know that the daily chart can afford a pullback and search for a higher low. And if we're counting trend here, let's just begin from the CPI gap up. We have lows, higher lows. These technically are not higher lows. We never flipped into an hourly downtrend over here, so you could call them soft higher lows. That's a term that we've used around the channel before. But if we were to break down through that, you could still find a daily set of higher lows above the last set of higher lows and respectful of your breakout structure here, closer to 451.10. So I think the look on the daily chart is very, very straightforward. If we were to take out the lows of this multi-day consolidation right here, your obvious target is a retest of the breakout point where you can still remain in an uptrend by finding higher lows around 451.10. Now, it's worth pointing out here that the trend, in terms of the pattern trend that is, of gap and go, consolidate, squeeze is coming to a little bit of an end. Remember that this consolidation produced equal highs, and this consolidation actually produced an excess high on the Wednesday of last week. So if this was going to continue the sequence, right, on this gap up this morning, we should have seen gap and go. Obviously, it wasn't the case. Now, this is not rocket science, and obviously we can clearly just see that, hey, we faded the gap, we're back down inside, but it speaks to momentum potentially drying up here, or at least changing. It's not as strong as it once was. So although, yes, we are in a very clear and strong uptrend, I think it's worth entertaining the idea that a breakdown underneath 453.90 could easily produce further pullback to rotate through some of this thin structure on the breakout and retest that level at 451.10. This is not as clean of an excess high as what we had on Wednesday of last week. We'll see that in the market profile specifically, but what we can start to look at this through the lens of is if this was truly going to be a breakout of this balance range right here, why were the buyers unable to defend the breakout point, aka the top of the range, at 455.50. It just simply did not happen. So once again, although we're talking about breakdowns underneath 453.90, let's not forget that the trend is up and we can still catch ourselves for a higher low around 451.10 on the daily time frame chart. To reinforce that idea, let's come in with a Fibonacci from the low up to the most recent high, and what you'll notice is that technically, if we do hold on to these lows here, it's being respectful of the 38.2. This is nothing more than bull flag consolidation. Over time, we will look for continuation. If we do break down underneath the 38.2, what's the line in the sand fib? It's always the 61.8, and look at how beautifully that aligns with 451.10 and the lower edge of this week's expected move. So on the daily chart, your key level to watch if we are going to move lower is right here at 453.90, then the lower edge of the expected move, and then if we are going to move higher, you really need continuation price acceptance up and over 455.50. Let's see what's going on and tell the story from the perspective of the hourly time frame chart. As we start to get a little bit closer to the price action here, we can clearly see that failed break. Obviously, we gapped up and out of the range, and we've closed back within the range. In terms of the hourly trend, we're in a very, very short-term downtrend, right? With highs, lower highs, technically lows, and lower lows. On the daily chart, we're making the argument that these are all roughly equal lows. This was a neutral hourly trend, so we don't technically have a breakdown searching for the daily high or low yet. But once again, it's very, very obvious that taking out 453.90 produces the pullback a little bit deeper to that daily breakout point here, 451.10. So everybody should be on the same page there. Let's take it one step further. Tuesday technically opens near the lows and under the lows of Monday, but near the lows of the Wednesday session from last week, right? And the bears do get some early price acceptance underneath 453.90. Obviously, this is where the dovish comments come out from the Fed, market rallies. So this was a failure from the sellers to break down underneath the bottom end of the range, and whenever the sellers fail, obviously it leads to strength for your buyers. And with the gap up this morning, the buyers should have materialized on that strength. You have the sellers failing over here, you get a gap up, up, what the buyers really needed to do to be constructive in the upward direction would have been something like this: gap fill reversal or a hold of the top of the range. So the sellers failed, the buyers have a gift. Now the buyers have failed, right back into the range, and the sellers potentially have the gift for tomorrow morning's open. This is a failed breakout, and all it should take is a move underneath that 453.90 to then give the sellers the upper hand. Let's think about why that takes place, right? Any breakout buyers on the long from the gap up this morning are now going to be overhead supply, underwater, no good, feeling bad about their positions. It gets even worse when any consolidation buyers through this range, of course, are broken down underneath 453.90. Now, not only are these people trapped, but anybody who initiated a new money long in the balance is also trapped. So the ideal move for a seller tomorrow is a breakdown underneath 453.90 or some sort of lower high underneath. Obviously, as we know, PCE is tomorrow morning. So a couple of gap situations to discuss would be if we open in range, it's anybody's game, right? I really would doubt that we open in range. I would hope that there's some sort of gap tomorrow morning, but opening in range, anybody's game. The buyers, of course, want to see something that looks like this. I would remain very neutral. Just as a blanket statement, I would remain neutral inside of this range. The daily uptrend is strong, but we are coming off the heels of a bullish failure, right? So the buyers really need to see price acceptance back over the top of the range, looking for 455.50 higher lows. The sellers can look for a breakdown, obviously, as we just discussed, for something that looks like this. Those are the very classic setups that come from opening back within the range. If we open on a gap down, I would be expecting inventory correction to close the gap. Maybe we close it all the way. A partial gap fill would also do. Then you're looking for sellers to really step back up on the retest of 453.90. And again, why does this dynamic work? It's because anybody who's a trapped long from in this box, if they have the best possible trade location and they want out for break even, all that pent up overhead supply now can sell for their first break even at the retest of the bottom end of the range. So lower highs underneath, again, kick us off to down here. Then you could look for trend continuation in the downward direction if you so desire. But just remember that if this does start to hold, if you do start, let's say that we gap down, right, lower high underneath, if you start to see an hourly double bottom down here, do not fight that. That's your daily higher low trying to be set. Right? So please do not ignore, once again, the power of 451.10 and the daily uptrend that is still existing. The other thing that could take place down there, as we know, is everybody's favorite pattern, the inverted head and shoulders, or of course, a very simple hammer candle down here. I also want to talk about how if we open in range, the pie in the sky inverted head and shoulders looks like this, right? There's your left shoulder, this is your right shoulder breakout through the neckline. You're looking for a continuation in the upward direction. If we gap up and out of this range over 455.50, I would look for a squeeze in the upward direction, because I do think you had some overzealous shorts who got involved on today's session. So gapping out of this range over 455.50, I would make the argument you probably want to be over this lower high that was set intraday at 456.33. If you can gap up over that in this range here, I think that's where you might see the potential for a little bit of a squeeze in the upward direction. We still have to contend with resistance at 459, and then the upper edge of the expected move is 460. Into the end of the week, let's just say that JPOW comes out on Friday and says, that's it, we're cutting rates, the market goes bananas. We're looking at 461.75 as your upper target, the highest one that we have on tap, and that is extended through the upper edge of this week's expected move. Last thing I want to show you on the hourly chart here is the intraday anchored VWAPs, and what you'll notice is that you're not really going to learn a whole lot if we're inside of that range. It will be constructive if we look like this. It will be constructive if we look something like this. Getting down underneath all of the anchored VWAPs would open up the door to say, okay, you know, anything. So here's the situation, right? And I know that we're going on and on about different pathing, but this stuff's really important, right? Some sort of double bottom that then fails up against the back test of the anchored VWAPs, which will be somewhere roughly in here, right? This is a daily lower high now, and now the CPI gap is in jeopardy. So that's a much worse bearish path if it is going to unfold that way, okay? So be aware of those anchored VWAPs. If we're underneath all of them and can't recapture off of a daily higher low attempt around this, I really would change my tone to at least being neutral at the loss of your strong daily uptrend, and really just dial back expectations there a little bit more balanced on that time frame. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, I would make the argument that we have mildly bullish internals throughout the duration of this week. You'll notice that the volume flows are positive 135 million. They're definitely not close to substantial. No individual day was substantial in the upward direction. In terms of the advanced decline line, moving in the upward direction, closing positive even on Tuesday. And on today's session, moving in the downward direction, but really beginning from trend higher higher zone. So it's difficult to say that, okay, it's really more bearish, whereas over here, we at least made it towards that zero line. Not really the case. Coming from trend higher zone, we were not coming from trend lower zone here on Monday, right? So a little bit more of a bullish edge happening there. And I think that the cumulative build really speaks for itself down below in the tick. Flat on Monday, sort of ending flat on the Tuesday session, and Wednesday building a bit into the afternoon, even though the market was down aggressively. So that's the thing to focus on here, is even though we were selling off quite rapidly into the sort of afternoon session here after the lower high inside of the previous day's range, which we did discuss on the SPY hourly, right? After this starts to take place, notice that your internals, they didn't flip aggressively bearish, right? This is still positive here in terms of volume flows, and again, still very much so well over the zero line. So I have to give the buyers the benefit of the doubt, and again, which that totally aligns with the daily trend being strong right now. Could this be an exhaustion gap up? Of course, it faded and we moved into the previous day's range. It's possible, but at the exchange level, you're not really seeing deterioration, and we'll see that in other supporting evidence pieces as well. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, I want to talk about how the value area and point of control technically migrated higher with price on today's session, even though it didn't feel like it. Obviously, there was some aggressive movement in the downward direction. The value area and point of control are certainly higher than the Tuesday session, and the point of control actually closed outside of the entire balance range that we've been referring to, right? We know that this is really the look there, and the point of control was technically above. Now, this is not just a holy grail. The market needs to move higher. We've got to move in the upward direction, but it's certainly not as bearish as it could have been. If the sellers were really going to commit volume down here at the lows, you would sort of be of the understanding that this is a completely failed breakout, and then the next big look is underneath the low of last Wednesday's session over here. That's exactly where you can see the low of day from today's session. It just simply did not take place. The other thing to point out here is, like we were describing, the Wednesday excess high was much better. Notice that back here, you just have a string of single prints up at the highs of that session, marking the proper end of the auction. So if there was going to be a top, this was looking like some topping activity. Notice that there's not a whole lot of volume commitment up there at the highs in relationship to the distribution of the profile. If we come over to today's session, don't get me wrong, I mean, it's still thinner volume up here, but you do get a little bit of a bump in there. You can see a lack of material excess at the highs because there's only one TPO sticking out to the upside. It's just not the type of topping activity that you might associate with a blow-off top like what we had of last Wednesday. It really wasn't emotional enough up there, and we actually did get a decent little intraday, 5-15-minute pullback near those highs before reversing back in the downward direction. So because of all of those reasons, I wouldn't be as convinced to say that this must be a topping style pattern. Again, we understand that you might have trapped buyers up there, but it's not an excess high like what we had of last Wednesday. Let's change gears and take a closer look at the QQQ NASDAQ 100 on a daily time frame chart. What do we see here from a trend perspective? Certainly still in an overall uptrend, very much so like the S&P, producing a higher high at the top of today's range, then closing a little bit weaker than what we had over in the S&P, at least on a relative basis to the breakout of last Monday, right? In the S&P, we're talking about a balance range that breaks, and then when we break, we're getting to the breakout point from the Monday session. That's not the case over here in the NASDAQ 100, and instead you can see that if we start to break down underneath 387.25, you're really building out our classically now called Man Ray pattern, where we build out a head and shoulders, if you will, with a double top, and then your right shoulder could come underneath on a lower high expression underneath that 387.25. So I'm being highly attentive to that as a possible reversal pattern here for the QQQ daily, but once again, I want to be very, very transparent. We are not in a daily downtrend. We will not be in a daily downtrend until that lower high is actually produced. So please don't jump the gun on this type of pattern. You would need to see this level fail and then subsequently produce a lower high underneath. And then, of course, we're aiming for the CPI gap close below. Of course, it's worth pointing out that we did have a failed gap and go this morning. So once again, this pattern of gap and go, consolidate, squeeze is coming to a bit of an end. We did have, again, the same phenomenon with a better excess high on the Wednesday session of last week. We'll see this on the market profile. A worse looking high at the highs of today's session instead over on the NASDAQ. So again, your main level to be focusing on for the NQs, or at least the QQQ cash, would be at 387.25. Breakdowns get you to 383.25. Unlock unlocking the CPI gap if we remain inside of range here, a break to higher low over the top of the balance in here. You really just need to see a daily close outside of that level at this point in time is 391.15, and the structural target, of course, you would have to look for today's high of day, but beyond that is 397 flat. Let's take a look through the lens of the Fibonacci, if you will, from the CPI gap to the most recent high, just to illustrate that you're not as concerned with your 38.2 up here producing bull flag consolidation. However, as we know, the 61.8, is always a line in the sand fib. So if this is going to materialize as the Man Ray pattern, a loss and lower high underneath the 61.8 immediately puts into play higher odds of the 100% retracement towards that 383.25 level in the first place. Let's move on down now to the hourly time frame chart and look through the lens of what we have here. You'll notice that we did not have as aggressive of a failure on the Tuesday morning session, so I would not read into that as much as what we did over on the S&P, but you can still very clearly see the intraday lower high underneath that 391.15, indicating the failure of the buyers on the gap up to produce an hourly higher low above the top of this balance range over here. So just like what we have over in the S&P, opening in range is neutral. Opening over or higher lows above coming from within are bullish. If you open above, any pullbacks above are bullish. Pullbacks also could have the potential to squeeze here with some overzealous shorts in the face of some not as bullish market internals, especially over on the NASDAQ side of the market, but you really saw that illustrated on the NYSE side, right? So opening on a gap up, I'd be more inclined to think about the squeeze, but again, still, this is fine for the buyers, higher lows over. That 391.15 obviously opening on a gap down. It's sort of, I wouldn't call it game over, but you certainly have a lot of overhead supply to contend with. I might even point out this level right here to you, which would become a bit more important than the true gap close at 388.90. 388.90 represents this inflection point. If you want to consider this a range, right, there's your look below and fail, goes through the top. We're technically above that as of today's close. If we remain on a gap down, try to go for a partial gap fill and do not really, exceed 388.90, that's where I would look for your stronger drawdown to really produce the beginnings of the Man Ray pattern from the daily chart that we were just looking at. Let's take a look through the lens of the anchored view apps intraday. You can see that these aren't really offering up a whole lot. Obviously, much more constructive higher lows away from the cluster in the upward direction, much more constructive to the downside. This really speaks to the daily, right? On a breakdown here, lower high underneath that 387.25 that we were just referring to. Remember that this 388.90 is a minor level, and we'll of course cover that in tomorrow morning's pre-market live stream as well. Targets to the downside, again, quite clear, 383.25. Let's take a look at the market internals for the NASDAQ side of things, and what you'll notice is just a little bit more weakness. Typically, there's more volume flowing through the NASDAQ side of things, so to only see 154 million in the upward direction, whereas the NYSE was, 135, there's really not that buffer or the padding that you would expect in the upward direction. So a little bit weaker from a volume flow perspective. We were much closer to trend lower zone on the Monday open, but don't get me wrong, we did battle up to the zero line. We did close negative on Tuesday, positive certainly on today's Wednesday session, but look at your cumulative build out of the tick. This is where this really shines to compare and contrast the two, right? If I just even scrunch this off to the left, look at how much more aggressive the bearish build was on the Monday session. Tuesday was completely flat, and Wednesday is really nothing noteworthy here in the upward direction. Let's finish off the NASDAQ side of the market with our market profile, and what I just want to point out again is specifically look at the volume profile at the highs of today's session. Lack of material excess here at the highs. Compare this, notice the bulge in volume and then thin structure, right? Compare that to what we had on the Wednesday session of last week when literally nobody is transacting near those highs. This is the sort of point I'm trying to make about the excess high being stronger over on last Wednesday. So if a stronger high was going to hold as a rejection, it was looking like this could have been it. This is really not the volume and commitment structure that you'd like at the highs. Don't get me wrong, it's not the end of the world. It doesn't mean that we need to be bullish. It doesn't mean that we need to look for moves in the upward direction. Just want to point out that discrepancy. It does give you a little bit more of a bullish data point in your back pocket to say that, hey, the auction didn't really end properly at those highs. I wouldn't be surprised to see this area revisited. In terms of the volume profile and point of control, more appropriately, value area and point of control, notice that if this is your breakout range right here, the point of control out of the NQ was actually smack on that breakout point. Sure, the value area and point of control did migrate higher from the Tuesday to Wednesday session, but the point of control, a little bit more nuanced, did close outside of that breakout zone over on the ES as compared to the NQ. And last but certainly not least for our broad market lineup is IWM Russell 2000 and the small caps. What you'll notice is the chart's actually not as much of a Swiss cheese issue, and we can see it without being too obscure. Thank you very much, Rusty. But you'll also notice that we have a rinse and repeat. Very, very similar patterns happening here with a shooting star rejecting our daily 200 SMA after some sort of like excess move in the upward direction. I keep using this term excess. What does that mean in the context of the first break here? It's after breaking out of this previous high. In this context, from today's session, it's after breaking out of this from a balance range. So you are finding sellers who are stepping in quite aggressively near this 200 SMA, producing these sort of very similar inverted hammers, if you will. And notice that we did technically close back within the overall balance range. Now, it's not impossible for the Russell to find a higher low on the daily time frame chart. Notice that we would be coming from equal highs, but if you can find support over the lower edge of this week's expected move at 175.25, I think you're still in business for a higher low. Think about the trend like this: lows, higher lows. Higher lows really just want to remain at this point after this first pullback anywhere over that 175.25. Don't get me wrong, on an hourly chart, is there a breakdown to be had there? Is there a short to get there? Absolutely, but I'm not sure I would overstay my welcome in the beginning stages of what seems to be a reversal, all based on this as sort of a weekly inverted head and shoulders, if you will. So holding the retest of that neckline, the lower edge of the expected move, 175.25, that's the zone that you want to be very mindful of. If we do continue in the upward direction, let's just say that we can clear this range back here. Of course, the two equal highs closer to 181 become a target, and then the origin of this breakdown here, the upper edge of the expected move, is very, very closely aligned to 183. Let's take out the Fibonacci's from this CPI gap like we've been doing in all the indexes thus far, and what you'll notice is you don't really get much here. There's not a lot of confluence. Maybe the 61.8 leads to the breakdown underneath the lows of the, what would that have been, Wednesday session of last week, Tuesday of last week, Monday and Tuesday of this week, so I could pay attention to that, but really more so on the hourly time frame chart. As we start telling ourselves the story over here, you'll just notice that these are failed breakdowns from the sellers. Number one, then we get back into this range, building it out further. On the Monday session, this kept us on the right side of the trade, especially over on the ES, noting that quick rubber band back in the upward direction. Same thing here on the Tuesday morning session as well. So although the lower wicks are more closely aligned to a 61.8 here, notice that there's not a lot of price acceptance actually underneath that 177.75. So I'd still use this as a structural level. So what's the game plan going forward here? Of course, this I guess it did technically close in. I was going to say this saving grace level, we've closed right on it at 179. For the most part, with PCE tomorrow morning, I'd be expecting a couple of things. Opening in range, just like everything else, more neutral. Opening on higher lows or breaking to higher lows over 179, looking for continuation in the upward direction. If we do gap down under the entirety of the range, I would be expecting something that looks like this. What's the reasoning behind that? Just like you had in the S&Ps, overhead supply failed breakout here, opening on a gap down, I could really more so see the Russell selling off aggressively. It tends to have a habit like that, right? Makes really aggressive morning moves as soon as the bell rings, so on and so forth. You can see the habit that the Russell has. If that's going to be the case, opening down here, I think that you very promptly make it towards that 175.25, and then it's up to the market to decide. Bear flag consolidation, reversal, XYZ. I would be looking for first sort of idea, daily higher low to hold. If it doesn't, we will reevaluate and then probably look for a stronger breakdown under 174.20 to close the CPI gap, not tomorrow morning's PCE, but the CPI gap from way back over here. That's not a top of mind priority, closing this gap tomorrow, but again, opening on a gap down under this range, I would tend to think that we could make it here sooner rather than later. What do the anchored VWAPs have to say for the IWM Russell 2000 and the small caps? And absolutely nothing. They're just all beautifully stacked sideways. I actually don't even think that I've ever seen anything this stacked, this sideways in a very, very long time. So I think that this totally just speaks to the narrative that you want to be extremely conservative in here, looking for breakouts if we can do this, looking for breakdowns if we can do that. Let's jump on over to the market internals for the Russell side of things. What you'll notice are mild volume inflows. Again, nothing to write home about over here, not substantial on an individual day. Falling out of trend higher zone today, but coming from trend lower zone on Monday, closing negative on the Tuesday session as well. Taking a closer look at the cumulative builds, bearish, bearish and slightly bearish on today's session. Again, noting the structure of the daily chart, the shooting star, if you will, whatever you want to call that, inverted hammer, definitely looks to me that this is the risk into the end of the week for a pullback under 177.75 to retest 175.25. Let's jump on over to the market profile and end on a solid note here. Lack of material excess at the highs, and this is the kicker. Where's the point of control? Where is the value area? I mean, this chart really just speaks for itself. It's completely different from what we saw over on the NASDAQ and the NYSE. Point of control is slammed into the low of the day. Value area is certainly lower in the individual profile. And if you were to look at this through the lens of a breakout range, right, obviously your point of control is underneath there. So a little bit more bearish out of small caps looking for that pullback underneath the bottom of the range. So let's jump back on over to the platform and evaluate one step further behind the curtain the weekly performance of our S&P sectors. Notice that leading the pack here is the XLRE for the real estate sector, up 1.62%. It's extremely lightweight and technically might have a bit more of a defensive posture to it, considering it's a hard asset generally used against, or as a hedge, I should say, to inflation. So it's not like the most risk-on indication up there. Materials, extremely lightweight sector as well. I mean, we're talking about less than 2.5% of representation in the S&P. The heaviest weight sector towards the top here is the XLF financials, up 0.71%. Pretty decent. If you look at the XLK, it's almost, I wouldn't say flat, but not really pulling its weight in terms of upside for the week, up about 0.4%. At the bottom of the barrel, it's the healthcare sector. So again, thinking about this is a heavier weighted sector, but it's also D for defensive. So we're not seeing a risk-off rotation lead this market in the upward direction, but we're also not seeing the heavyweight tech sector just completely fall off of a cliff here. So everything's making sense that like the lightweight sectors are leading. That's not necessarily risk-off. The risk-on sectors are more neutral on the week, and the risk-off sectors, the defensive sectors, are actually towards the bottom of the barrel. I mean, barring XLC, we know that XLP, XLU, those are the defensive sectors, and they're actually getting beat up just a little bit down here. So let's take a look at the structural charts and really evaluate what's going on. Should we be concerned about any leadership issues? I mean, absolutely not. Real estate blasting off to the upside with some of the dovish comments and really the expectations that rate cuts will be coming as soon as Q1 in 2024. That wasn't the case just a couple of days ago. We were expecting Q2, so no surprise to see real estate higher. And again, upward pressure is upward pressure. It's just not enough to sustain a market rally. Obviously, we have not seen a sustained market rally. If today was an up day, I would say, hey, yeah, big red flag. This should not be taking place. Real estate should not be leading a sustained move higher, but that's not what we got. We got a pullback, right? XLB, same comments, right? Moving in the upward direction here. Lightweight sector, upward pressure is upward pressure. Not an issue. It's not the thing propping up the market currently. Let's move along. Financials, definitely much more important, right? Made that full rotation to the prior pivot high. What's the name of the game? Just because we found a higher high in this overall sequence, right? Last major daily high was back here. Even if you want to look at this high, we haven't seen a red bar. I'm not going to count them. You can do that, hit pause and count. But my goodness, it's totally fine to look for a higher low pullback out of financials. Not the end of the world. First line of defense, 35. Anything over this prior pivot high, how can you be bearish on a chart that looks like that? Look at this 100% retracement, and it's stair steps down, elevator up. Typically, it's the opposite, right? So it's very difficult to have much more of a sustained bearish stance on the market right now when there's such room for higher lows across lots of the sectors we're about to look at. Here's the XLY, right? What you'll notice is that we broke out of the balance range and we pulled back to the top of the balance range. The breakout, by nature of being a breakout, produced a higher high. So what's the name of the game? Higher lows are continuously going to be on the table. Now, because we've already looked into the gap once, I would really not want to see much more than just consolidation in here and another reattempt out of it. Obviously, if we spend more time, if we are getting continuously rejected up against 169, I would have to concede that, sure, there might be the opportunity for a head and shoulders reversal. We'll look for the CPI gap close. And then even at that, like, let's not forget where we're at from a weekly perspective, right? Is it not possible that even if we get this whole sort of path to unfold, where's your weekly high or low? Lows, higher lows, higher lows. So again, I don't mean for this to come off as like being overly bullish or overly cocky, but just the nature of the chart is really not all that concerning. Sure, you can get something that looks like this. Resistance trend line might lead to a pullback. I'm not denying the fact that this, of course, has an opportunity to offer lower highs on like a monthly or weekly chart as well, but it's difficult to be an outright bear coming from this massive rip in the upward direction with structure supporting evidence for a higher low. And that's really the name of the game. As I go over to the XLK, I'll keep it a little bit briefer in some of the other sectors. I mean, bull flag consolidations at the highs, broke to a brand new all-time high, even if it does break down. I mean, weekly high or lows anywhere over 175.70. Let's move along XLV healthcare sector. I mean, not for nothing, but here's kind of like this as a general idea, pulling back into this area. If we can hold 129, it remains bullish. As you know, the more time we can spend sideways in this range, it's actually healthy for the broad market as a whole because this is D for defensive. We don't really want it leading, but because it's the second heaviest weighted sector by market cap, we don't want it falling off of a cliff. So I don't really see any issues with the XLV here under the current posture. XLC, same comments basically as the XLK. Pullbacks are totally fine anywhere over 68.10. Does it mean some, immediate bearish pressure during the pullback? Sure. And we talked about how we achieve that out of the SPY daily chart anyways, so there's really no surprise there. It's not going to change the daily trend, right? So let's move along and let's take a look at energy, just a balance range. Keep it simple, over or under, lighter weight sector, not as concerned. XLP, what's going on with consumer staples, break over the equal highs, and you still have not even retraced the origin of the big weekly breakdown. Any leadership issues? The answer is absolutely not, because it is a risk-off sector. Upward pressure is upward pressure under the current circumstances. XLU, same comments, although we're already at the origin of the breakdown. Any higher lows go. Constructive uptrends here are fine. And again, not really seeing a leadership issue. Here's XLI for industrials. I feel like I'm just a broken record. You guys get it at this point. There's certainly an opportunity for a higher low. Could you be attentive to all of these range breakdowns that get us to the weekly or daily higher low and look for a short on the SPY as that's unfolding? Again, the answer to that is absolutely. But in terms of how you should approach the market as a whole right now, I'm not really seeing posture or sector structure offering a big bearish setup in the downward direction. Let's even extend this over to the SMH and see what's going on with semiconductors. And this is almost a mirror image of the XLK, right? All-time high is here. We didn't quite make a new high on today's session, but even if we do pull back, again, the name of the game is any weekly high or lows over 152.25. Ideally, the daily pullback would close the gap, then rotate back over the previous all-time high at 161. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. As we know, the XLK ratio is the most risk-on ratio. It continues to outperform here by staying high and tight in this consolidation, not breaking for a lower low, and really just going sideways up here. So this does continue the risk-on posture for the market. And what you'll also notice, one of the things we talked about on Saturday, was that we wanted to see financials break out over this flat top. That certainly was the case on today's session. So if the baton is going to be passed, it is being passed to the right sectors here, noting that the XLV, which is D for defensive, risk off, right, is moving in the downward direction. XLY is trying over here, but ideally we got to break to a new higher high in this general sequence. As we saw in the structural chart, unless the S&P really pulls back aggressively and the XLY is just kind of neutral, I don't really foresee that happening into the end of this week, unless there's, again, maybe there's a big gap up tomorrow with PCE. We'll take it in stride, but it's certainly not it's not an issue right now. It's not a big red flag saying like, whoa, this is falling off of a cliff, risk off is around the corner, right? If we look at the risk off sectors, again, moving lower, rejecting the 50 SMA. Energy is slightly lower. Obviously, real estate is outperforming with what's going on with rates, but overall, the ratios right now would speak to risk on, maybe a little bit more on the neutral side of that, but certainly not risk off at this point in time. Let's take a look at some specialized ratios, which will really just reinforce the same idea. XLK, SHY, certainly bullish up here sitting on the higher highs. That is a risk on indication. XLK, XLU, same idea, breaking out over that flat top. Certainly high and tight consolidation. There was no pullback to the 50 SMA. Even if that does happen, you could get a rinse and repeat of what this looks like over here, right? You get, actually, it's fairly close, right? There's your sort of double top, back down towards the lows, 50 SMA rebound. Here's your double top, dances around, 50 SMA rebound. It's certainly a possibility, and the trend here is quite strong in the upward direction. Once again, this is a risk on indication. Then let's go apples to apples, XLY, XLP, starting to get some price acceptance over the top of the range over here. That does strike me as a bullish indication. Now, there's nothing suggesting that we're out of the woods yet. You'd really like to exceed both of these highs over here before you say, yes, we're breaking away from this as a balance range. As of right now, we're giving it the benefit of the doubt, but again, to be more confident, exceed both of those highs, you're really looking at a stronger risk on indication. Right now, it's still bullish given the current look on this particular chart. Let's jump on over to the dollar. There's some interesting indications happening with the dollar right now, clearly moving through the midpoint of the overall range. It wouldn't be unreasonable for the dollar to get a little bit of a snapback here, right, to produce a lower high. And the reason I say something like that is specifically due to what's happening with gold. If we take a look at the gold contract, obviously we had a roll of the futures contract here, so ignore some of the price discrepancy, but nonetheless, we've been talking about this as an inverted head and shoulders. Even if you just wanted to call it a flat top, it totally worked out in the upward direction. It did break, and the precursor to all of this was what was going on over in silver. So if silver was the precursor, right, which on Friday of last week was the first one to break in the upward direction over this flat top, notice what's happening currently. Silver's coming into this area of potential rejection. If silver pulls back, which is totally reasonable after making a higher high, gold could thus pull back, and therefore the dollar moves in the upward direction. What does that do for equities? Puts a little bit of downward pressure on equities, and once again, wouldn't be unreasonable if we break the 3 or 4 day balance lows to offer some sort of daily higher low. So watching this relationship quite closely as silver starts to maybe foreshadow a little bit of a rejection up here. Let's just go back to that gold contract and take a look. Obviously, these things will be rocking and rolling tomorrow morning at 8:30 when we get the PCE inflation report. We're right at these highs as well out of gold. So again, not unreasonable for a little bit of a pullback around this zone. Let's move on over to rates. Speaking of PCE and Fed speak and all this good stuff, you'll notice that the TNX actually broke down underneath a very key level. This is coming from, I know we can't see it on this chart right now. Let's go to a 2-year chart. This is your prior high in rates that we broke out over and promptly went to 5% from, right? And as we've been discussing, this is kind of a head and shoulders. And you might say, like, Matt, nobody actually trades the TNX. You're right. But you could look at something like the ZN, right? The notes from the bond market perspective. And this broke out over the inverted head and shoulders neckline, right? So because of this, if this breakout's going to continue, not for nothing, the measured move of a inverted head and shoulders, right, is usually something like this. That would forecast that rates are very likely going to continue in the downward direction. And this really marries up with some of the fundamental narrative that's being put out there right now. If we take a look at this inverted ZT, again, there's a contract roll here, but even without the contract roll, this has to strike you as alarming. Like, whoa, what's happening here where all of a sudden the expectations are that the Fed is going to start cutting rates in 2024? Is it the economic slowdown data that we've been getting? Well, GDP from Q3 just confirmed the print at, 5.2. We'll see that in a moment. That looks pretty good, but the devil's in the details here. You'll notice that if you actually paid attention to some earnings calls from consumer staples companies, and we'll show you some examples in a minute here, consumer spending is deteriorating a little bit. And if the consumer stops spending, Powell might have to stimulate here. So watching very closely if this inverted ZT actually sticks. Let's move on over to the tracker tool. So just like we have concerns out of the inverted ZT falling so rapidly, I mean, look at the new forecast for rates going forward. We're seeing much more aggressive cuts, no longer seeing, well, first and foremost, the first cut was originally priced in for June of next year. Now it's being priced in as soon as March, right? Or excuse me, May. You'll also notice that March, speaking of March, is now at a 50% odds for hike versus pause. This is kind of an indication that the Fed's maybe worried, or the market is worried, that the Fed has over-tightened things and they'll need to do the rescue operation and intervene sooner than the anticipated plan. So remember, the Fed can tell you one thing, but if the market's pricing in something different via bonds, totally different story. And right now, the speed, the acceleration that we're seeing, even just compared to the weekend check-in on Saturday, is very dramatic and might be an indication that something will break here, or there's concerns of deflation, of course. If we take a look at the economic calendar for the remainder of this week, I mean, not for nothing, the GDP came in at 5.2 as the preliminary Q3s, right? So pretty strong there. That doesn't really seem to be an issue. One of the things that we will continue to monitor, obviously, I mean, this goes without saying, PCE tomorrow morning, as well as the unemployment claims at 8:30. We do want to see a, sort of right on par with the forecast here, 0.2 out of PCE, and really nothing over 250K out of the unemployment claims. That would be a decent read there. Any misses on either of those numbers, so over 250 or over 0.2, I think the market has a bit of a temper tantrum forecasting, okay, the Fed's got to intervene here. Otherwise, we are headed for kind of a disaster. The recession would seemingly, start to pick up some momentum in terms of that as an overall likely outcome. At the very bottom of the screen, though, let's focus on this as well. If we're going to pay attention to some economic strength indications, I mean, manufacturing PMIs and prices will be a pretty big one as well. And we'll see what Powell has to say on the Friday afternoon session here as well. Really excited to see the FactSet earnings report, which will resume on December 1st. So we'll update you in the Saturday video. But here is your earnings outline into the end of this week. The main thing to focus on tomorrow after the close will be Marvel from a chip making perspective, Dell, the dinosaur, if you're interested in old tech. But here we go. Remember, I was just mentioning, and big shout out to Michael, always posting wonderful charts over on the old Bird app, now X. read some of these. I'm not going to read them out loud to you. You can pause your screen on some of them, but these are all comments that have come from the Q3 earnings calls from retail sort of CEOs, as you can see here in their quotes. Oh, so beautifully done from Michael. And what you'll notice in all of this commentary is that the consumer is still spending, but they're making some trade-offs. They're very careful with their spending. We're expecting sales declines. It's turning into a little bit of a challenging landscape from a retail spend perspective. So you can feel free to read some more on this, but it does pair nicely with some of the comments that we were making earlier when it comes to the state of the consumer, really. Let's jump on over to our risk appetite indications for the broad market as a whole. Starting off is none other than the TLT ratio to the S&P. What you'll notice is that we're still suppressed underneath the resistance trend line over here. And if we break it sideways through time, I want to be very clear about this. We talked about it on Saturday. If we just break this by going sideways through time, not via an aggressive uptick, I would not be concerned about a flight to safety style trade emerging. Really doesn't seem like an issue as of right now, especially when we pair that with other data such as bonds in relationship to themselves continuing to fall into downtrends, making new lower lows on today's session. That is bullish and speaks to a more certain future and not everybody rushing into short dated assets, right? Let's move along and take a look at credit spreads, especially if we look at credit spreads, again, new lows, especially on the medium term IEF LQD, SHY HYG, not quite there yet. But again, when these are falling off, you're especially not as concerned about your TLT ratio to the S&P really perking up aggressively. So with this data really coming together to support the same mission, it doesn't really seem like a flight to safety or risk off style period for the market, which is making total sense based on the price action. This one's a little bit of a head scratcher with the HYG junk bonds, right? Really breaking out here, whereas the S&P faded all day. So watching that quite closely, we do actually know, if anybody has been paying attention and keeping track at home, let's just back this way out to a yearly chart, right? If this is just stuck sideways in a range, I mean, we broke that range long ago over in the S&P. So if this is doing a longer term campaign, so to speak, to play catch up, I mean, this divergence, if it is going to come back into sync, we've got a ways to go in the upward direction. Expect for these to be disjointed for quite some time. It's not typically how it works, but it's one possible theory explaining the big disjoint into the end of today's session. Let's move along, take a look at Bitcoin, obviously remaining strong, high and tight consolidation in a bull flag after a range break from back here. That is a risk on indication. Moving along to our not risk, but rather market breadth. I do want to leave this zoomed out just as the general reminder, as we always do, in the early stages of a recovery. At this point, we're not even early stages anymore, but this does not have to be blockbuster reads. We do not need to be at 500. Another week positive is a check mark for our buyers. Looking better from a breadth perspective, SPX A200R, stocks trading over the 200 SMA in the S&P, positive up and over the 50% mark. Obviously, it's all positive, but a big move in the upward direction, sustaining more companies over the 200 SMA, just to really boil it down. Obviously, that's a bullish indication. So that is helpful for our buyers. If we take a look at the SPX A250R, I get my numbers all screwed up now. So everybody's on the same page. Stocks in the S&P over the 50 SMA, we're starting to get closer towards the contrarian zone, but we're not all the way there yet. I would not jump the gun and say, oh, the market's got to crash, it's got to pull back aggressively because this is approaching the same level as what we had over here. But it's something to keep in mind, right? And this has been one of my issues with the market this entire rally in the upward direction is it's felt like it's a balloon just floating away higher and higher and higher. You're chasing it. So I also, in the same vein to the downside, would not want to just aggressively start shorting the market because you feel like these indications need to present an opportunity to the downside. That's really what I'm trying to get at here. It's a bullish indication. Can it start to get into contrarian zone? Yes, we're just not there yet. So that was a really long-winded way of expressing maybe just dial back expectations of a big, outright collapse if a pullback does start to develop. Here's the RSP equal weight S&P 500. Obviously getting some price acceptance over that 145 here. The more time that we can spend at or around it, the better. What you'll also notice if I zoom in, this is a really nuanced take, is notice that the RSP higher low, very, very much so a higher low compared to the balance range lows versus the SPX weighted, not so much. So it's a subtle bullish indication, but let's not lose track of the major divergences that are here. Like we can't, you can't, what do they say, throw the baby out with the bathwater or something like that. I mean, a substantial lower high. Similar comments over here in the QQQE versus the NDX. We're not going to rehash the same thing, but there you are. Here you are. Same comments with the lows of today's session. Then lastly, for our market breadth, let's take a look at the Dow transports because these are actually one of the things that could start to be an early indication that yes, you can build confidence in the pullback if if transports break down underneath 14.7 with a lower high here, keep in mind that obviously industrials have broken way out, or like not for nothing, but we didn't even create a higher high over on transports. Obviously, we've broken out and some over on industrials. If this is going to break down underneath that left shoulder mark, back down underneath here as well, you're starting to get a too big of a disjoint from Dow theory perspective, where you would say, okay, probably don't want to have any more expectations of industrials moving in the upward direction for the broad market. Obviously, that would spell a headwind. Let's move along and take a look at the VIX, see what's going on from a volatility perspective. Clearly making new lows, but starting to get a little bit of an uptick over here. Nothing major, but again, because it's so suppressed, it would not surprise me to see an uptick out of volatility. It's really, that should not catch you off guard, especially if you're someone who you should be, if you've made it to this point in the video, is tracking the VVIX, right? The VVIX is also getting some lift here off of these almost complacency zone lows. So this is actually a healthy indication. Again, markets do not tend to move in a straight line. This move that we've seen here is, I don't know that I would call it rare or unprecedented, but it doesn't last forever is the main point I'm trying to make. And seeing this tick higher might be an early indication to say, hey, this could be coming to an end. We might actually start to see a deeper pullback, right? Give and take, give and take. The VVIX would be an indication, an early one, that maybe we're about to see some take. Let's move along and take a look at the volatility futures. Really deep contango over here, absolutely a non-issue. This is a bullish data point for the market. Same thing out of 9 versus 30-day VIX, and you'll also notice the one-day VIX perking up a little bit. We printed the lowest low that the brand new instrument has read ever on the Monday session. Again, give and take after making the lowest low, a little bit of an uptick here, not unreasonable, especially paired with what we just discussed over in the S&P, being able to find a little bit of a pullback underneath the shelf of equal lows. If you've made it to this point in the video, let me know down below in the comments section. Make sure you're also subscribed. I would have to imagine you are, and most folks do not watch this far. But anyways, this one's for you. What do we have here? Apple. We certainly see a balance range up at the highs. Any consolidation underneath 190.15, looking for breakdowns underneath 188. Any consolidation above, obviously looking for the opposite. In terms of the upside, I would be more willing to go with a breakdown from the range, as in the first breakdown, first trade through that 188. I wouldn't necessarily wait for the lower high here. But in the upward direction, because of this move, because it feels like, again, this is a feeling. This is applying human psychology or human emotion to the market. And that's not always how it works, but it feels like we're chasing higher highs. To be sure of the breakout and that you're not going to get trapped at the worst possible long trade location, I would really want to see the higher low above. So although it may deviate from trying to be emotionless in market trading, this to me is a way to make sure that your psychology is on point and you can actually manage your risk effectively. So the higher low over 192 is probably what I would be looking for there. And not for nothing, a range doubling, as we know, is typically what we're looking for. It's also prior structure here at 195 as a target. Moving along, Microsoft, what do we see out of Softy? Brand new higher high, all-time high, not for nothing, on the gap up from this morning's session, but closing not quite as a bearish engulfer, but pretty darn close if the close was just a couple of ticks lower over here. What you will see, moving on down to an hourly time frame chart, is that this can start to emerge as like a compressed man ray, if you will. You know, call it a pattern, call it a head and shoulders man ray, whatever you want to call it, doesn't really matter. Basically, what you have is overhead supply, failed breakout traders, or anybody who bought the gap up this morning is basically screwed, for the lack of a better term, if price accepts underneath 379. From there, you have very clear targets or inflection points to be thinking about. A breakdown through this prior structure over here, 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 of course, opens the door for what? The stronger rotation lower into 371. Now, let's not forget, we just produced a brand new all-time high, so the chart by nature of that is, of course, more bullish than bearish, but there is a scalp available in the downward direction for a trade that looks like that. And just like we can have a head and shoulders in the upward direction, we can have the inverted in the downward direction, something that does this, with then continued price acceptance over 379. Of course, flip the script, looking for new all-time highs and continuing into blue sky territories. Here's Google. Let's keep it on the hourly chart. Google, of course, broke down through some key structure. I'm looking for continuation here. Any rally attempts that reject underneath 136, looking for the full rotation through the thin structure to the top of the gap daily 50 SMA at 133.33. If there is going to be a turnaround Thursday, you really have to see it up here. There's no way around it because of this now acting as overhead supply. The only time to flip back bullish is on a higher low over 137, then you're targeting your equal highs at 139. Moving along to Amazon. What do we see out of Amazon, the old mini beast, last but not least the mini beast? 147, lower high, very clear into the afternoon session. So what's the name of the game? Extremely similar. Any consolidation below, looking for a breakdown, and your target is not this arbitrary level, but instead meant to stop the cursor there at 143.30. So call this your head and shoulders, call this your lower high, call this a breakdown point, right? And you might even want to have this additionally on your chart at 146.15. You guys know the rules, round numbers only. So underneath that opens up the door for that breakdown. And again, your target 143.30. Just like what we were saying earlier, if this is going to produce a turnaround to the upside, if this is going to act as a higher low, which it definitely could, like let's not lose sight of the trend of the chart. Lows, higher lows, possibly higher lows coming from a higher high. But really on the hourly chart, you have to do something about this lower high that was offered into the afternoon session of today. And that, of course, is a higher low over 147. So that's Amazon. Let's move along and take a look at NVIDIA. What's going on with NVDA? We had a gut feeling. On that Tuesday session. It actually worked out. We were saying, all right, technically we're going to be opening back over the top of the bottom of the balance, if that makes sense. We're going to be opening over the bottom of the balance. There we are. And it just, it didn't, this is much more so indicative of a distribution up here. So I would tend to still be a believer that the sellers are trying to gain a foothold out of NVIDIA. Consolidation through here now is a little bit difficult, a little bit sloppy to trade. The better short is going to be continuation underneath 476. Let's jump that over to flat number. And then the better long is, of course, higher low. Like you have to turn this into a sort of, like, lack of a better term, rounded bottom. If this is going to be like sellers trying to get aggressive underneath the overhead supply, you've got to put all of them off sides with a higher low above. And in terms of the rounded bottom, that might look like a cup and handle. Then you break back up to the origin of this most recent leg down, and then really the top of the nail in the coffin at $500.75. So one step at a time. I would make the argument bearish until proven otherwise in this consolidation. This would prove me otherwise. This would prove me right. Looking for some follow through. So NVIDIA, treat that kind of as a range there. Next up, Metaverse. What's going on with Zuckerberg's ACL? Looking like it's getting some more damage done to it. Lower high into the afternoon session, 333.75. Breakdown from this as a range. What's the daily look like here? Actually, that's kind of interesting over on Meta. There you go, right? So there is your head and shoulders. Can we break that trend line? And if so, I would say the stronger short really is like 329 goes. This is just kind of it's there. It's technically a level at 324, but your stronger one is this breakout where we did the dance around 317. And we also know that 317 is a line in the sand to keep us out of this prior chop zone from over here. So really watching this 329. Can we or can we not hold 329 on the Meta daily time frame chart? If we do, all right, fine, benefit of the doubt, weekly bull flag. If we cannot, and we start to get hourly lower highs or price acceptance underneath, the stronger rotation is 317 as a target. Tesla, what's going on with Mr. Musk and the rocket ship? Tried to gap out of the range, no dice. So out of this one, I would start thinking about look above and fail. If the broad market as a whole is bearish tomorrow, especially off of a PCE catalyst, I'd be thinking about, bottom end of the range here, right? As we know, look above and fail always targets the opposite end of the balance, and that would be 230.65. You do have some roadblocks to get through here initially. The main one being right here at 238, right? Big breakout. You could likely retrace that thin structure fairly quickly underneath 240, 225, trade to 238 quickly, and then down to here, do the dance, make sure that the sellers are still in control at this level, and then you're targeting the bottom end of the range. If you do find support over here, there's not anything saying that this technically can't be a constructive uptrend. So again, your major inflection points, I'd care less so about the 240, 225, and more so about the 238. How do we resolve that level? As of right now, it is a bearish pattern with a failed breakout from the gap up on today's session. Moving along, last but certainly not least, is Netflix. What do we see out of Netflix? I have not jinxed it yet. We've talked about it for quite some time, but the pattern here is extremely clear, right? Flag, 3-bar play, flag, 3-bar play, 3-bar play, flag, whatever. We're getting this extremely tight consolidation range right up against the highs. Here it is on the hourly time frame chart. As we get closer, you can see that there is no need to complicate whatsoever Netflix. It is simply going to be an over, or it is simply going to be an under. 481.75 and 476.50. Those are the two numbers to contend with. If it is under, you're looking for 467.45 as a possible target. Overhead is a massive gap, as you can clearly see notated right here, and that gap closes up against 506.60. So what does that mean to the upside? From a risk-reward perspective, please understand you do not have to be the first one in the door to make sure that the risk-reward makes sense. There's a lot of overhead range here. Make sure that we continue an hourly uptrend when we move into the gap. Do not just be the first buyer there. You can wait and look patiently for a higher low. If this fails back in, you'll be thanking yourself saying, hey, I wasn't the sucker who bought here. I was the sucker trying to find the higher low. I at least knew immediately where my stop was. And lastly, a couple of trade ideas before you go tonight. J&J Johnson & Johnson is up first. What a beautiful double bottom over here. Of course, we are in an overall downtrend, so understand that you are going counter trend if this does decide to play out. And it would be helpful if the broad market was moving in the upward direction on some sort of positive catalyst from PCE. So keep that in the back of your mind when looking at J&J. But nonetheless, the flat top breakout point, the neckline of the double bottom, 152.50. If we can clear that and the daily 50 SMA, the target overhead is the open of this red bar back here, where this, as a daily double top, really kicked off the continuation of the downtrend. That target is 155.50. Notice that in an overall downtrend, we are not overstaying our welcome. You probably want to be fairly aggressive, taking profits up against that, close out like 3/4 of the position, and then try to let a couple of runners ride, but you're not looking for a grand slam off of Johnson & Johnson going counter trend at the bottom of an overall move. Next up, Starbucks. What is going on with Starbucks? Let's take a look. 100% retracement and the opportunity for a dead cat bounce first and foremost, but then looking for this gap to close underneath, right? So the main idea here is that this is a 100% retracement. It's very rare that you just immediately continue through 100% retracement. So any lower highs that are set, looking for a subsequent test of the equal low underneath 99.75. The door is wide open for an earnings gap to close. Now, we're not making the argument that all of it has to close in one day. You could look for your 50 SMA to act as potential support in the midpoint there, which is currently trading at 96.75. So that's about 3 points underneath you, right? There's some range to trade for there, but the main idea is look for a lower high. If a lower high is set, ideally the lower high is just anywhere underneath 104.30, right? And then you can start to even make the argument, here's like this really ugly looking head and shoulders, right? Underneath that neckline into the gap, you start looking for it to fade. So this would be a bearish trade idea, helpful if the broad market is moving lower. What else do I have for you? DASH, DoorDash. What's going on with the DoorDash? Ding dong ditch, no DoorDash. Certainly a bearish trade. And the reason for this is that on today's session, we see this big upper wick take out the top of a consolidation range. Clearly, there's no acceptance from the buyers over the top of that breakout, and we close weak back in the midpoint of the overall range. So all it's going to take, in theory, to turn all of this into overhead supply is a breakdown underneath 93.60, trade through the thin structure. First target is here at 90.40 as a bearish trade, and then the bottom of where this is all originated from is at 85, right? Let's go down to the hourly chart. You can just see that there's not a whole lot of structure at all underneath us. So if this goes, I mean, this is fairly rapid. This could even be fairly rapid looking at what we have back here as the breakout was taking place. So that is DoorDash in the downward direction. Obviously, it's not a short if we never break down underneath 93.60, right? This is really what allows you to make sure your risk reward is tight, right? Entering on lower highs underneath, entering on the break. If you are a swing trader, right, using risk that kind of looks like this, really a swing trader probably wants to target these lows. Just understand the timing associated with that. That's not a 1 or a 2 day trade, right? So keep that in mind if that's how you decide to play it. That's DoorDash. And then last but certainly not least is good old Disney. What's going on with Disneyland? Let's take a look at the daily time frame chart. And what you see here is a beautiful gap fill reversal, closing as I would call it more so a doji, not so much a hammer. But what I'm really interested in is the idea that we gave a gap fill reversal and then closed right at the lows of the large red-bodied bar. So if the sellers got overzealous on the lows, if this is nothing more than a low, higher low, and again, a higher low right off of a gap fill reversal at 91.50, all it should take is a long over the hammer high to retrace the thin structure from the breakdown to 95. Here it is on the hourly time frame chart. Quite clear, right? Buyers obviously responded. Tweezer bottom, some people call that, right? So if we're over this high, look left. There's really thin structure through here as the sellers were getting aggressive. The origin is sort of this as a head and shoulders neckline at 95. So looking for that as a retest. Again, we're not gunning for like highs, all-time highs, anything like that. This is just a reversal off of a technical pattern, gap fill reversal, right? So that's going to do it for today's episode of the Midweek Market Update. If you learned anything new or enjoyed the episode, let me know down below in the comments section or by giving the video a very simple thumbs up. Once again, you're probably sick of me saying it, but coffee and donuts up in the penthouse tomorrow morning for PCE. The live market reaction, we will begin at 8:15. The data comes out at 8:30. I hope to see you there. With that said, I wish you all a green trading week.